Vinit, good morning. Good to have you back. Vinit, enough and more has been discussed and debated that where and why mid-cap stocks are up. But after the sharp sell-off yesterday, do you think we are nearing the end of the party for mid and the small cap stocks for an extended period of time? Is the party over? So the Cinderellas of the world be worried now?
Good morning, Nikunj, and I think it is extremely tough to really make out, of these daily moves. And I think the way current, sentiments are around the mid cap, small cap stocks, the kind of flows which we are seeing in these categories, I would say that these small corrections will be really bought into, and people may not really give up till the time, there are, let's say, bigger triggers. I mean, there are actually no any big negative signs or any big negative triggers which can spiral into a problem as of now. But I'm saying that the world is in a very disorderly state. I mean, we at one end we keep talking about high interest rate, recession fears and all of that, and at the other end of the spectrum there is so much money in India which is actually flowing into the small and mid caps for right wrong reasons that time will tell. I think fundamentally, as the companies which keeps showing strong growth over the long period of time, they will eventually emerge out as winners, and there will be definitely in this rally there will be spaces which will be low quality, will be run purely on themes, not backed by numbers. Those will be cause of pain and hurt for many investors. So I think the best thing to do at this moment is to be very clear around how one is assessing quality, how one is assessing the length of the growth prospects for each of the companies. A lot of themes are just being talked about. I think one needs to be very clear about these themes really showing in terms of numbers, and I think those will eventually do well, is what I feel. And hence I think the focus has to be there on quality, and in the short term I think it's very difficult to take calls, but to me I think these small falls will be bought into, and hence I don't see major correction unless there are some big negative events which turns out.
As a fund manager, how would you value these three pockets? Defense, railways, and power.
So the question is, how do you value, or what is the view?
Value them. Purely, fundamentally speaking, if I have to ask you a question, that how would you
Right.
value these three themes? Because they are the most talked about themes right now.
Absolutely. So see, as fund houses, even we have invested into these themes. Maybe in some of them we have got into quite early. Now, at the moment, what are we doing? At the moment, we are not selling out of these themes, because we definitely understand that these they are supported by strong order flows. When we are talking to, let's say, the companies, the experts in the field, and we are seeing the data points, the momentum is pretty strong. Let's say defense, the order momentum is strong. Power, we know that we are at a peak power deficit. The capex needs to get accelerated. Government is taking actions. There is a lot of quality improvement which is happening across discoms and all of those. So I think some of these steps and are giving you signals that they are in the right current environment today. But most importantly, one will have to recognize that the stocks have seen vertical movement upwards, and the earnings growth is not going to be vertical movement upward. Despite these order books and strong momentum, you will have quarterly volatility for these companies, which has always been the case in the past, and hence how one deals with that through the next 3-4 years is going to be the important thing. So for us, if you ask my opinion, I think these are good sectors. We are seeing positive trends. We would like to hold on till the time that things turn adverse or data shows any adverse momentum. But at the same time, we are also cognizant of the fact that the quarterly flow of earnings may not be in sync with how the stocks have moved, and hence there could be periods of low growth or consolidation as well in these categories.
That's quite interesting that you made that point, Vinit. But the question is, about a year back, the strategy was pick up a bunch of railway stocks, bunch of power stocks, bunch of defense stocks, right? You made a basket of all of these. But do you now have to be more selective if you have to either add positions or even get in a fresh post whatever correction that plays out in these names?
No, I think a strategy to have 3-4 stocks across these themes is a right strategy, because we have seen that the volatility around a particular name could be higher depending upon the order flows, the quarterly adjustments which happens in case of these companies. So I think it is always good from diversification, from risk mitigation perspective, to have a good quality 3-4 set of these companies to play the theme, because and also it is going to be very difficult to maybe own a significant proportion of these companies due to liquidity not allowing that from a large size of fund perspective as well.
Okay. Do you think banks could be the new defensives now? I mean, it's something which we were discussing. Normally, banks are considered to be cyclical, but could they be the new defensives for next 2 or 3 years? Valuations are okay, visibility is okay, cycle is okay, and NPAs are low.
Yeah, I mean, Nikhil, without labeling them as defensive or growth, I would say that bank today makes a lot of more sense, because whatever growth we are talking about in the economy, definitely it has to happen through the banking sector. And what we are talking about, this investment growth, which we are sensing through some of these sectors. My sense is that, or some part of that benefit will definitely accrue to the banking sector. There is a lot more fear than the real the real status of the banks today. The fear is that we are at a peak, names will compress. But my sense is that even if it compress, still the banking sector as a whole, they are in the best form and shape today. There is a decent growth as far as the credit environment is concerned. The credit quality is in the best form today. So my sense is that even if the margins were to come off a bit, but I think the growth metrics would be there. The valuations are pretty reasonable, and what we talk about the economic growth, I think that should be played through the banking sector overall. Now the choice can be how one has to allocate between the banking and the non-banking financial companies. I mean, that is left to each one's individual assessment. But I think this is a good sector to own. Even from the profitability perspective, it accounts for almost 35% of the profit pool of the Nifty. So that's a large sector one can't ignore.
Vinit, there's a Goldman Sachs report yesterday which talks about cash levels with mutual funds on an average are between 4 to 5%, and that is slightly higher than historical averages. So can I safely say that even if markets they correct, then is enough and more cushion which will come from domestic investors? A, cash levels are high, B, SIPs are strong.
Yeah, so that's what I was saying, that the small falls will be actually bought into, because there is a lot of optimism, and hence we don't see a big drawdown as far as the markets are concerned, unless there are bigger events to worry about. So I think you're right, especially even in the small and mid cap categories, the valuations are expensive. We are cautious, but the cash levels also, and the cash flow into these categories also in a way indicates that the falls, the drawdowns may not be very severe, and hence and small falls will be actually bought into as I see the scenario as of now.
Vinit, the cautious stance on the capital goods sector, given the fact that we have a lot of market experts and corporates themselves as well that are betting on a strong manufacturing renaissance in India, we are seeing evidence of things picking up on ground as well. So what prompts that cautious stance?
See, the cautiousness is not about the economic recovery or the growth, which I also mentioned that we are very confident about that. We are looking at the data. The caution is more on account of the valuations, because what I'm actually seeing is that people keep talking of the same story, and those stocks are getting bought into, and there is almost like a vertical, one-sided move which we have seen. And what I mentioned is that what is going to happen is that eventually the stock prices finally has to find its support in terms of the earnings growth, and in the long term, it's the earnings growth is what is going to define the percent increase in the stock price. So my sense is that as we go through these quarterly earnings, the earnings are not going to be as linear as the stock prices have seen the moves in the last few months. And hence there will be room for volatility, and that is the reason for caution, because the valuations are slightly on the high side.
Vinit, even though you believe that the small cap corrections are going to get bought into, but are there spaces within mid and small caps which are at least in the near term looking overheated to you?
Yes. I mean, overheated. There are, as I said, the same sector which we are talking, the capital goods, even consumer for that matter, considering the growth momentum has slowed, and valuations have not corrected to the extent the fundamentals are actually showing up today. So if you ask me, two categories which are on the expensive side, one, the capital goods stroke capex related themes, and the other is the consumer discretionary and even non-discretionary to some extent. These are the spaces which are on the expensive side. The others like banking, insurance, healthcare, these automobile, these I feel still are on the relatively much better placed when it comes to valuations.
Would you believe that some of the new age tech companies, listed players, merit a relook? What's the general view there?
I mean, surely I think some of these new age tech companies are now talking about reduction in the losses, which is very, very important from the long term valuation perspective. And some of them have started showing green shoots as far as the profits are concerned, and hence they definitely merit a relook. And we as a house also, we are sort of maybe looking at a couple of those names and which are still maybe under our evaluation.
Vinit, you made a very interesting point about banking, healthcare, autos, and insurance being the undervalued pockets. Let's pick up one of these sectors, one by one, each of these rather. And I want to talk about banking first, because what you're seeing in banking is a stark dichotomy between what has happened in the last 1 month, what's happened in the last fortnight, and what's happened year to date, right? So, while there is a large part of these private banking, large cap names which have been underperforming, last fortnight or so, they've begun participating. So again, what's the strategy when it comes to banks? Stick it with PSBs because year to date they've performed the best? Or would you say go with the underdogs because they've just begun their move?
So our strategy has been to stay with the large private sector banks in a meaningful manner. There are some exposures we have with the PSU banks as well, the large ones. But more importantly, what we have also sort of analyzed and we are thinking is the fact that as we keep talking of peaking interest rates and interest rate at some point, starting to look down south. These banks, the NBFCs will be beneficiary of that environment, and they will see expansion in margins where the fear for banks is the margins will contract. So I think we have taken decent exposures to some of the NBFCs as well, and that's how we have been strategizing as far as the banking sector is concerned. But by and large, across our portfolios, we are almost equal weight or overweight the banking sector as of now.
So if one has to look at IT, where the world is literally divided because of disruption and because of the macros, what is the way of looking at IT now?
So, see, IT, I keep talking about IT as one of the sectors which I generally have a positive bias towards because of a simple fact that this is a very strong cash generating sector. And more importantly, this is a sector which also distributes a large part of the profit back to the shareholders. And hence, from let's say dividend yield or cash flow yield perspective, this is one of the better sectors to look at. And when it comes to the balance sheet strength, I would say that if not better, they are at almost at par with how the FMCG companies' balance sheets are. So I would say this is one sector which it has a good long-term metrics also, but it will keep having these volatilities around growth. So as of now, we are in a slow growth environment, and that is also a good time to look at the sector because some of the large companies are available at decent valuations. Only point is that maybe one will have to go through 1 or 2 quarters of slow growth environment and some bit of underperformance as well. But that's the cost one has to pay if one has to be slightly early in the segment. So I think that's how we are looking at the sector.
Is happening to flows in small and mid cap stocks? We keep on getting data that large part of the flows are moving into small and mid cap stocks. It is the real reason why markets are moving higher, because if funds are coming to mutual funds or schemes, by default managers will have to invest. Is this the reality that it's compulsion which is driving some of these stocks higher?
So I would say, Nikhil, this is one of the reasons. But the other factor I would say is that if you look at one more data point, I just saw this data point that the promoters selling in 2023 has been the highest, around 80,000 crore worth of stocks is what promoters have sold, and I think versus this last year was less than half of the number. Now, what I'm also witnessing is the fact that there are a lot of these small family offices which many of these companies have started opening. So there's a lot of money which is not only coming by way of mutual funds through the small and mid cap schemes, but there are these family offices which have got set up. There are these HNIs who have become very active, looking at the last 3 years of very strong growth. So I would say there's a huge amount of capital which is chasing this category, just not the mutual fund. And when one actually, and I worry a bit, because when I look at the quality of companies, now in the last 1 or 2 months in the small cap space, which have been rising, sometimes it creates, some bit of concern in my mind that, again, we are drifting down the quality chain. And whenever the turn happens, because markets are not going to be linear, and whenever the turn happens, this is going to cause a lot of pain, because there will be a lot of new investors, excited investors, looking at the last 2-3 years of data point and then coming up. They will be surely up for disappointment if the investment methodology is not right, if they don't pick the right companies and they go down the quality chain. I mean, that's going to be very risky affair.
All right, it's been a pleasure having you on board. Thanks so much for giving us a lot more clarity as to what the market approach is and your preference in amidst a pretty volatile time such as this.